Code 3 Americans, welcome. Want to do a quick story on kind of what may be a cause of some of the housing inflation, or not, maybe not what might be, what is. Going through a news article on Yahoo Finance. I'm just going to read a couple quick highlights here. It won't take very long. Then I'm going to show you a couple charts. But basically, it's a story about an ongoing dispute in Florida, in Orange County, Florida, talking about how high rents have grown, which they have over the last couple years, and how it's unsustainable. And the one of the co-founders of a social justice group called Florida Rising is quoted in here as saying that corporate landlords, real estate investors, and developers are raising prices and making record profits while hardworking Orange County residents are priced out of their communities. Well, that's tight. That what they're doing there is they're tapping into emotions, not critical thinking. And yes, there are high profits, and there's also some builders and developers that are probably scraping to produce new product to even make the deals work. So it's kind of both can be true. But I wanted to point out some actual content. I think we're littered with misinformation anymore. And I guess that's kind of the buzzword nowadays, misinformation. But at the end of the day, politicians, central planners are making decisions about things, and then those things produce an expected result. And then all of a sudden, they come in and they start blaming people that were forced to migrate or pivot around the world, or pivot with the world as it changed around them, and make decisions to kind of weather the storm that they brewed up, I guess. So I just want to show some data indicating where this may come from. Obviously, I got a background in construction as well, so this is something we've been living in addition to everybody else, I'm sure. But I wanted to point out a few things here that are pretty objective and get rid of the subjectivity. And the point being is that these politicians and these people that are on these social platforms and politicians looking for votes, they're tapping into emotional thinking instead of just looking right in the mirror and saying we created this problem. And so let me show you that here. Let me share my screen. All right. So if you look at here, I know everybody's talking about federal debt anymore, and M2 money supply, or how much money the government is quote unquote printed. That's not what this video is about, but that's fairly widely misunderstood. Not all government printing ends up in money circulating in the real economy, but certainly during the illness, that's certainly what happened. And I want to show you some data illustrating that right here. As you can see, federal debt increased about 31, I call 32% over a couple year period here, from about 23 trillion to 30 trillion. Okay, remember that about 30%, give or take a little bit, as we kind of go through this. So if you look at uh, balance sheet of households and nonprofit organization, look down here in the bottom right where it says deposits. You'll notice that at about Q1 of 2020 up through kind of the end of 2021, early 2022, that balance sheets increased about, look at that, almost 30%, pretty similar number. So in other words, deposits, banking deposits went up about 30%, and so did federal debt. That's kind of interesting. And this does not account, anything in this video does not account for stock prices increasing or any other type of asset. We're just talking about deposits in this particular slide, though you can see the others layered on top. And you can go to the Federal Reserve, St. Louis Fed's website, and pull up the same data yourself. But just notice it's deposits flown up about 30%. Why? Well, look at that same period of time. Personal saving rates skyrocket. I mean, we're talking, what would that be, about 5 times, about 500% increase relative to stimulus checks. All of a sudden, people had purchasing power in the form of liquidity. It wasn't tied up in just equity or something like that. So where else does it show up? It shows up in the price of real estate. Again, here's a number, about 30%. So sorry about that, about 30% in real estate is this is off the balance sheet of, again, households and nonprofit organizations. We go from about 30.6 to 39.5 trillion over that couple year span, and it kind of parallels the federal debt growth. So obviously, there's upwards pressure on real estate. But in addition to that, there starts to become supply chain problems. There starts to become labor shortages, which labor in the construction trades, I can speak from experience, has been getting tighter and tighter all the time. Aside from all the stuff just been going on the last couple of years, so labor in construction, the trades are not replacing folks as fast as they're retiring out, and that's going to continue to be a problem. But materials also started to face troubles, and this might be partially why as well. Again, more purchasing power. So this is refinances. This is according to Freddie Mac, one of the large agency lenders. Um, Refinances were up about 75% over that period of time. Well, when interest rates drop, all of a sudden people can refinance and they can lower their monthly payments. Now, if they've lowered their monthly payments, they have more purchasing power in cash to do home remodels, go on vacations, buy new vehicles, buy used vehicles, buy ATVs, whatever they do. But some people would have remodeled homes, which would have put more pressure on labor and materials, because cash out refis either lowered payments or just gave them immediate influx of liquidity. Maybe they remodeled a kitchen, a bathroom, put an addition on, things like this. That all puts pressure on an already strained labor market and starts to really put pressure on material supplies, especially in a time that a lot of the production facilities were shut down at the beginning or when the sickness was kind of setting in. And if you look at construction materials here, the producer price index, according to the St. Louis Fed, if you look how it skyrockets, about 50% increase over that period of time, when everything else was going on with the illness. And I'm trying to choose my words carefully there so not to get censored. But the green line just represents Fed funds rates. Notice how when it plummets, when it hits the floor, that's the government's response to a sickness. Look what happened to the producer price increase. It starts going through the roof. Purchasing power increases because people could reach into the future and borrow money on the promise they would repay it with their future labor. And the cost to borrow that money was cheap. And the red line's just showing 30-year mortgages going down. But the point is, as interest rates and borrowing power, borrowing costs go down, all of a sudden, producer prices go through the roof, in particular construction materials. Now, keep in mind that also directly correlates to cash out refinances, not just interest rates. Now people have immediate liquidity they can put in homes and so forth. So if you look at mortgage-backed securities, as you know, the federal debt I already illustrated went up about 30%, a little over that. Well, part of what they do is they buy mortgage-backed securities. That's part of what they did. They wanted to prop up the housing market. So basically, when a bank makes a loan, they don't hold that mortgage forever. Eventually, it gets sliced up and divided into these securities, basically investment vehicles that normally would get sold into like Wall Street or institutional investors or whoever would buy them. Well, it's here the Fed just stepped in and they said, well, we'll buy them. We'll buy billions a month in mortgage backed securities and we'll do it for super cheap. So that loaded up their federal debt. It pushed easy money to housing. And look, this is exactly I put Orange County, Florida on here just because that's where I seen the news story. But look at their days on market. In other words, in a really tight real estate market, as you know, days on market will be very low. In other words, a house doesn't sit very long before it's sold. It went from 51 days in March of 2020 to 29 days in June of 2022. And that's about a 43% decrease. At the same time, mortgage backed securities are going up 93%. So not only are people to go out and buy new homes when the Fed is flooding easy money to housing, but it starts to put when they're buying new homes, that puts more demand on labor and materials. But it also puts the Fed could be buying some refinance packages. So again, flooding easy money, easy liquidity to people that are trying to stay in their home. Maybe some people remodel their homes and don't put them on the market, so it kind of adds to the shortage. So point is, I think we're flooded with an environment where people are blaming landlords and business people and investors, and certainly that's a thing. They've definitely been raising rents and making some profits, but at the same time inflation's been through the roof and these people are business people, so they move to a place they can find yield. They seen what the government was doing, that they were shoveling money toward real estate, so they got in the path of progress. They thought, well, geez, if inflation's 15%, I need to be 25% or 20%. I got to be positive arbitrage there. So they move to a place that it makes sense. They're not going to sit in a place that it's losing money. So this is one more reason that we got to learn to think critically, not emotionally. If you notice, all the narratives are written out of emotion anymore. And Code 3 Americans know that we got to move into assets, because that's where essentially, inflationary times benefit asset holders and they punish wage earners and savers. So when the government's recommended everybody save money and work hard and go to college and take debt and student loan and all this stuff to get this good high paying job and save 10% and avoid debt and what have you, that really doesn't work in an environment where they're over there pulling the strings, creating these huge imbalances that are killing wage earners and rewarding asset holders. Well, that essentially erodes the middle class. It puts a divide between the haves and have-nots, and when that divide gets big enough, who's going to step in to fix it? It's going to be the central planners and the politicians looking for votes. So they're going to start to enact measures to try to close that gap. That ultimately leads towards socialist type principles over time. We're already seeing that. Um, so at the end of the day, that could be, those types of principles could be universal basic income or debt forgiveness, which just means retransferring debt from maybe student loans or whatever the case may be. It's all going to create inflationary pressures. Typically, people in asset positions are going to benefit, and that's how we can keep the debt or the gap between the haves and have-nots from getting too wide. Is giving people real financial education, pushing them into assets, getting them to play the game based on the way the people are structuring the game to be played. And that's probably that's the number one thing that can preserve American freedoms, is pushing people to gain personal financial independence so they're not reliant on government social programs in the future, excuse me, which just further exacerbates this problem. So anyway, just a quick video. I want to show you some data. Hopefully we can end some of the emotion. I mean, if you look at the news anymore, it's all based in emotion and so little is based in fact. Until next time, we'll see you. We'll see you on the next video. Let's look how we can get into some assets, some real financial education. If that's already you, how you can bring some other people alongside you to share with them what you already know. So until next time, email community@code3assets.com. Give us a like on the video on YouTube, and we'll keep some content coming.